America is $36 trillion in debt. That's a number so big it's nearly impossible to comprehend, but it's still money owed to someone. People often point to China as the biggest lender, and sure enough, they hold about $750 billion worth of it. But here's the thing. China is also drowning in debt of its own. In fact, over $18 trillion worth and counting. So who's holding their debt? A lot of it sits with Chinese banks. But those same banks also own debt from the United States. And American banks, they're holding debt from China and Europe and just about everyone else. If that sounds confusing, it's because it is. The deeper you go, the more entangled it all becomes. Every country is borrowing. Every country is lending. And somehow the world is now $300 trillion in debt, triple the size of the actual global economy. But if the world is in this much debt, then who is it all owed to? It's a really simple question, but one with a surprisingly complicated answer. Don't wait. Protect your wealth and explore the opportunities in gold today. Visit gold mining, ticker GLDG, and see how you can be part of the next growth story. Right now, as millions of Americans go about their day, something quietly dangerous is happening. People think they're being smart, clicking on holiday deals, stacking appliances and TVs into online carts, swiping credit cards, charging 24% to 30% interest for items that were quietly marked up a month earlier, only to be discounted today. On the surface, it feels clever, like they're beating the system. They're not. What's really happening is far worse. The middle class is walking straight into a trap disguised as normal life. A trap made out of debt. The one thing most Americans assume they can manage until they can't. Because the truth is brutally simple. The system isn't cracking anymore. It's actively collapsing from the inside. And every deal, every swipe, every buy now, pay later order is another tiny brick in a wall nobody realizes they're building around themselves. But this story isn't just about consumers sleepwalking into financial quicksand. It's about something deeper, a shift happening at the core of the global economy. A shift analysts warned about for years, a shift that the average person still hasn't connected to their daily life. And if you understand what's coming next, you'll understand why millions of people won't see the collapse until it has already hit them. Perfect. I've got your exact chapter 2. Now, I will reverse engineer it while keeping the storytelling style, tone, pacing, structure, and length, but rewording it slightly to make it copyright-free. Here's the rewritten version. So if every nation is taking on debt, who exactly are they borrowing from? And if everyone owes money, who actually receives it? When we hear about the national debt, it's easy to imagine some shadowy figure sitting on a pile of cash, controlling everything. But the reality is far different. Modern debt doesn't just move in straight lines like we might expect. It circulates. To see this more clearly, let's focus on the United States, the most indebted country in the world. You might ask, who could possibly lend them so much? Surprisingly, about 70% of that debt is actually owed to Americans themselves. In other words, the U.S. is borrowing from its own citizens. Here's how it works. Governments borrow money by selling bonds, essentially a promise to repay with interest, just like you might take a loan from a bank. So who buys these government bonds? Chances are, it's people like you. When you deposit money into a bank, it doesn't just sit there collecting dust. Banks put that money to work, growing it through loans, investments, and yes, purchasing bonds, passing some of the gains back to you as interest. Right now, U.S. commercial banks hold nearly $1.8 trillion in treasury bonds. That's 3 times the entire GDP of countries like Brazil or Canada. Bonds are popular because they're considered one of the safest ways to earn interest on idle cash. Unlike the stock market, their value doesn't swing wildly every day. Of course, governments can adjust interest rates to guide the economy. In the 1980s, bond yields soared above 15% as authorities tried to curb runaway inflation. During the COVID recovery in 2020, they fell below 1% to encourage spending. But once you buy a bond, the interest rate is fixed until repayment. Whatever the government does later doesn't affect your guaranteed return. A 10-year U.S. Treasury today offers a steady 4.5% annual yield. Quite solid given the minimal risk. That's a major reason why bonds and debt are so widely embraced. And it's not only banks investing in bonds. Anyone with a sizable pool of funds can take part. Pension funds, insurance companies, investment firms, they all do the same thing. Buy bonds and earn interest. In 2024, U.S. pension funds allocated a quarter of their holdings to bonds. In 2024, U.S. pension funds allocated a quarter of their holdings to bonds. Insurance companies went even further, placing over 60% of their assets in bonds, using them as a safe and steady way to grow their capital. This creates a hidden web where individual savings are effectively loaned to the government. So while it might sound strange that the U.S. borrows from itself, it's really just money moving from areas where it sits unused to areas where it's actively spent. When the government pays interest on its debt, that money flows back to the lenders, increasing their cash reserves. And what happens next? They buy more bonds, earning even more interest. This forms a self-reinforcing cycle where money continuously circulates from lenders to borrowers, then back again, over and over. The same system exists internationally. About 30% of U.S. debt is held abroad. Just like American banks and pension funds, foreign governments and banks invest their surplus funds in U.S. bonds. The process repeats. Money flows in as the U.S. borrows and flows back out as debt is repaid. And it doesn't stop with the U.S. Every nation participates. Japanese savings fund Dutch loans. Dutch savings fund Brazilian loans. Brazilian savings ultimately find their way back into American bonds. Global debt isn't just a heap of unpaid bills waiting to blow up. It's a vast, interconnected network where money circulates in loops from savers to borrowers and back. Governments borrow, investors lend, and interest keeps the system moving. While some of this money crosses borders, most never really leaves the network. It simply changes form, exchanges hands, and keeps circulating. So if governments keep borrowing and spending, how do they ever pay back what they owe? The short answer? They usually don't, at least not in the traditional sense. Instead, they take on new debt to cover the old. It might sound reckless, and in some ways it is, but it's also the backbone of how the global economy functions today. Why doesn't the cycle stop? Because modern economies and even politics are built around debt. Here's the uncomfortable truth. Borrowing fuels growth. When a government spends borrowed money, it injects cash into the economy. Companies earn more, employees get paid, and people spend more. This loop keeps the economy moving and growing. Without it, everything slows down. Take China, for instance. Roughly 19% of government spending is financed through borrowing. That's 1 in every 5 yuan coming from debt. In the United States, the ratio is even higher, around 25%, roughly the same as what the government spends on education and social programs combined. Stop borrowing suddenly, and the flow of money stalls. Businesses earn less, people lose jobs, and spending contracts. The very loop that drives growth flips into reverse, leaving everyone worse off. History shows what happens when borrowing stops abruptly. In Greece, during the 2008 financial crisis, panic led investors to avoid Greek bonds. The country could no longer borrow, quickly ran out of cash, and had to slash spending. 1 in 4 public workers lost their jobs. Wages fell by nearly a third, and GDP contracted by 25% over the next few years. Politicians and citizens alike understand the stakes. Nobody wins elections by promising austerity, so governments keep borrowing. But debt isn't just about growth, it's also about survival. Economic crises, like the COVID shutdown in 2020, forced governments to cover spending when citizens stopped paying taxes or consuming. The U.S. borrowed nearly $3.8 trillion that year, almost 20% of its economy. Other major countries followed suit. In such times, borrowing isn't optional, it's essential. And yet debt always has to be repaid. If a country is already spending everything it collects, where does the money to pay off past loans come from? The answer? More borrowing. Wealthy nations like Germany or Switzerland face this with little concern. Their bonds are safe, borrowing is cheap, and rolling over debt is manageable. For developing countries, it's a different story. Higher borrowing costs make each rollover more expensive, and over time, the debt can spiral out of control. Countries like Sri Lanka and Pakistan have found themselves in what's called a debt trap. They must keep borrowing just to pay interest on previous loans. So when people ask why the U.S. or other nations can't just stop borrowing, the truth is simple. They can't. The very debts that weigh on their shoulders are also the pillars holding the economy together. But this system carries risks. As debt grows, so do interest payments. Larger portions of government budgets go toward paying old loans instead of funding schools, hospitals, or infrastructure. Debt to GDP ratios approaching 100% are now considered normal, whereas decades ago they would have sparked alarm. Problems arise if lenders lose confidence. Borrowing costs skyrocket. One solution governments often turn to is printing money. But this isn't without danger. Flooding the economy with cash diminishes the value of each unit, causing inflation. Prices rise, savings shrink, and citizens feel poorer. Extreme cases can spiral out of control. In Venezuela during the late 2010s, the government printed massive amounts of money to cover debts. Prices doubled every few weeks, the currency collapsed, and ordinary citizens watched their life savings vanish overnight. Even moderate inflation can be harmful, especially for developing nations that often borrow in foreign currencies like the US dollar. A weakening local currency makes repayment much more expensive. As debt burdens grow, lenders become wary. Suddenly, they demand higher interest rates to compensate for the increased risk. When borrowing isn't enough to cover payments, governments face hard choices: cut spending, raise taxes, or print more money. None are easy, and each carries serious consequences. Even after taking these steps, there's no guarantee the debt will be fully repaid. If a country runs out of options, it defaults, essentially saying, "We can't pay." Unlike missing a mortgage payment, this affects an entire economy, and the government cannot simply borrow its way out because lenders lose confidence in defaulters. As the system becomes fragile and dependent on debt, people start searching for stability. That's why, in 2025, record amounts of capital are flowing into gold. Investors are seeking something real, something that isn't dependent on endless borrowing and repayment cycles. Right now, we're seeing something remarkable, an unprecedented rush into gold in 2025. And it makes sense. Gold has surged nearly 28% this year, while the dollar has dropped around 9%, hitting a 3-year low. Silver has just reached a 30-year peak, and mining stocks, as measured by the GDXJ index, are up close to 45%, an astonishing jump. Even the world's largest banks are making bold predictions. JP Morgan expects gold to hit $4,000 by mid-2026, with Goldman Sachs and Bank of America echoing similar forecasts. One company drawing attention in this environment is Gold Mining Incorporated, ticker GLDG, listed on the New York Stock Exchange. Its stock is trading roughly where it was in June 2018, back when gold was priced at less than half of today's value. GLDG is near a 5-year low while gold prices continue to climb. The company owns one of the largest gold and copper resource stage portfolios in the Americas, spanning roughly a dozen projects across 5 countries, including Canada, the USA, Brazil, Colombia, and Peru. with an estimated 12.4 million ounces of gold equivalent in measured and indicated resources and another 9.1 million ounces in inferred resources. But gold mining isn't just about mineral assets. It also maintains a portfolio of publicly traded equities and cash. The value of their equity holdings alone exceeds $150 million, based on market prices as of June 5, 2025, already surpassing the company's current market capitalization. Additionally, they hold $6.8 million in cash, reflecting the last reported quarter ending February 28, 2025. Put simply, their equity portfolio alone, without counting cash or gold projects, is worth more than the company's market cap. The gold sector faces a major challenge today: replacing reserves. To maintain production levels, major mining firms need either new discoveries or strategic acquisitions. This is where companies like Gold Mining come into play. The company is guided by an experienced leadership team. David Gaffaro, former CEO of Gold Corp; Amir Adnani, a serial mining entrepreneur; and other former executives from New. Insiders hold over 10 million shares, demonstrating strong personal investment. Major institutional investors include Ruffer, BlackRock, Spratt, Morgan Stanley, the GDXJ ETF, UBS, and Goldman Sachs, highlighting confidence from prominent stakeholders. Currently, GLDG trades at just 76 cents as of June 12, 2025. For those seeking exposure to gold price growth with a long-term development plan, GLDG presents a potentially compelling opportunity. Explore gold mining, ticker symbol GLDG.